Good morning, everybody. We've got a mostly lower trade in the grain markets here early on Tuesday morning. It is 6:30 a.m. Central Time. March corn futures down 1 at 584. March soybeans down 2.5 at 1248 and a quarter. March Chicago wheat down 2 1/4 at 786 and a half. March Kansas City wheat down 3/4 of a cent at 811 3/4. March spring wheat is down 3 cents at 1015 and a quarter. If you guys are listening on the podcast, appreciate it. Leave me a rating or review. If you're watching on YouTube, hit that subscribe button. My goal is to get to 5,000 subscribers on YouTube. We just hit 3,300 yesterday. So if you are not subscribed and you're watching these videos, hit that subscribe button, hit the like button, leave me a comment. All of those things will help me to grow this channel and to continue doing this. If you need some additional assistance from me, go to my website. It is www.standardgrain.com. Click on Grain Marketing Plan here in the upper right-hand corner, guys. Check out the subscription service. I talk about the service every day. One thing that you should be aware of is that with this service, I offer a lot of things, not only grain marketing recommendations when it comes to cash sales and option strategies, capture and carry. I also do a lot of educational type stuff. I did a video yesterday, and I do one every single day regarding a chart pattern. And I do stuff like this from time to time. There's a head and shoulders pattern on the wheat chart, and I went through an explanation of exactly what that means when somebody says, hey, there's a head and shoulders pattern on the chart. When you hear that on the radio or on TV, what does that mean? What does it indicate? What does it mean for the market? I went through a full review of that. So not only is it grain marketing information, but it's a ton of educational information as well. So certainly give that deal a shot, guys. Brazilian soybean planting is nearing completion. Private Group Ag Rural was out yesterday. They said that the crop was 96% planted through last Thursday. They did note, however, that there are dry conditions in South Brazil and that's an issue. There are farmers in some parts of those southern states that were forced to replant soybeans because of the dry conditions. But in general, Brazil planted beans very quickly this year, and that's going to have some implications in regard to exports, the United States, and I'll talk about that here in a second. But in general, Brazil almost done. They're in good shape. They do have certainly some problem areas in the south, but the vast majority of the country is in very good shape. Now, soybean export shipments out of the United States were soft last week, 1.724 million metric tons. The trade expected something in the 1.9 to 2.3 range. Accumulated soybean inspections for the marketing year out of the United States are down 21% versus the same period last year. Accumulated sales are down 27%. The soybean export window this year for U.S. exporters is going to be shortened on both ends. On the front end, it was shortened because of the hurricane. We had big delays in September and through a good chunk of October, and we're going to be shortened on the back end because Brazil planted early. They're going to have some beans ready early, and all indications right now, despite the issues regarding dry weather, is that they'll have a record crop in Brazil. So they're off to a good start, and it has implications for exports. We really need to see some improved export activity here the next few weeks because our window really closes, by the time you roll around to February or say mid-February. We do have a crush report from NOPA coming out tomorrow morning. This is the November crush report. Traders expecting another very strong number. Crush margins are pretty good. Ahead of the report, traders estimate that U.S. processors crushed 181.6 million bushels of beans in November, which would be down a little bit from the 183.9 in October. Still, if they realize if that 181.6 is printed, that would be the fifth largest monthly crush number on record. Crush margins are really good, and ideally, if we do lose some off of exports, which I believe will be the case, ideally we pick up all or most of it back in domestic processing. Crude oil prices have stabilized. We had a big spike down in crude oil prices on that initial COVID variant scare with the Omicron variant that we first heard about the day after Thanksgiving, I think. And crude oil prices, the WTI contract, spiked down to about $62. And we've essentially got kind of like a double bottom on the crude chart now around that $62 level. We traded there once in August, and then we traded there again more recently, and we've rallied back. And we've been kind of back and forth here recently in a more tight range, like 70 to say 73. There's been chatter that the new COVID variant would reduce oil demand. The International Energy Agency was out yesterday. They said that Omicron will dent oil demand short term, but that in general, a demand recovery for oil continues. So I think there's a lot of people who are still really positive oil. I know JP Morgan was out very recently with some pretty lofty price projections, like north of $100. So there's still some people who believe that the crude oil market could move quite a bit higher. The Fed starts its two-day meeting today, and they are expected to deliver one of their most hawkish pivots in recent years. We've been dealing with extremely easy policies in regard to interest rates, asset purchases every month, that sort of stuff. And they're going to start moving away from that. At least that's the expectation. The expectation is that the Fed will announce a quicker tapering process in regard to these monthly asset purchases. They're going to kind of lay out a path for higher interest rates. The path looks something like this if you're watching on YouTube. And I know these numbers are small, but essentially by mid-2022, most of the Fed members believe it would be appropriate to be up from zero currently up to maybe 0.5%, maybe a little bit more than that, maybe just 0.25%, but not anything very drastic in 2022. And then you've got a lot of members who believe that, we may be close to that like 1% Fed fund rate come 2023. And then longer run beyond 2023, maybe you get the Fed fund rate back above 2.5 percentage points. So we're not talking early 1980s here. We're just talking a move away from zero and towards some more, 1 to 2% type Fed fund rates, which certainly will have an impact on the economy. No doubt it's going to make money more expensive. You take a 30-year mortgage that you could do now for 3%, you might be back up to 5 or 6% a couple of years from now. So that's what's expected tomorrow. I don't know what they actually say. The Fed has had a difficult time tapering. They've had a difficult time raising rates. And this is not something new with COVID. This has been going on since 2008, these easy policies. So we'll see if they get away from that. The cattle market acted well yesterday. We bounced back after kind of a soft open and finished the day higher. So I'd say overall that was a very positive action. And the outside markets here this morning, U.S. dollar's a little bit lower. The stocks are mixed. The S&P's down 6. The Dow Jones is up about 15 points. Bonds off a little bit. Gold and silver off a little bit. Crude oil is up 19 cents in the January WTI contract, 71.47 last trade there. Everybody have a great day today. I will talk to you guys same time tomorrow.